Welcome to NGEN Markets Training session. So I hope I'm audible to everyone. Meanwhile, when others are joining in, we will be starting our session all together, and we will discuss the topics we are going to discuss today. So accordingly, today our topic is portfolio review and customized reports. So we will do the review based on risk and return, and on the basis of customized report, we will have a look into PowerPoint reports generated by NGEN Markets, and also we'll look for some Excel based reports altogether. And after that, we will be having Q&A. So you can write those questions on the chat box, or directly you can just tell us verbally, and we will address them. So I hope my screen is visible to everyone and I'm audible to everyone. So let me just share my screen of my terminal. So let's go ahead with the terminal here in the NGEN Markets. So I hope this is visible to everyone. If it is not, do let me know in the chat box so that I can address it. So here, when we look into our NGEN Markets to actually review portfolios, for an external client, and two ways to review. One of them is to review via portfolio section altogether here. So to review that, you have to click on the portfolio section here, and we have given a way to add in those portfolios directly into the system. So, you can add the portfolios here. You just have to click on it, and we have given some upload options and some manual uploading so that you can do. But here our main purpose is to review the portfolios rather than onboarding. So for reviewing, I'm just gonna load one portfolio here for a client, and we will review the portfolios based on some parameters. First, we will look into risk and return. So essentially, first we will look into these two parameters. So one thing here is that whenever we look into capital markets, we normally look towards returns. We have a biases towards returns altogether, but what we overlook is total, the entire risk we are taking for that particular return set. So that's why, whenever we look into the performances, we have given several tabs for you to actually look into what type of returns we are generating and what are the possible risks. So as an example, you can see here we have given some, like cumulative return, CAGR, annual return, and as well you can see annual volatility, and then there is annual VAR. So, we have given this performance stats accordingly for the particular portfolio. You can load it from the performance chart here. And essentially what we do here is that we only look into the positions what the client is holding currently, and not the transactions which has happened previously in the last couple of years, because that doesn't matter anyway in decision making. So for decision making, the client is holding this amount of securities. These are the 11 positions, which includes one stock as well, as you can see. And accordingly, you can take a call that whether to keep this portfolio as it is for the next couple of years, or whether to rebalance this portfolio with some changes or some allocations altogether. So the decision making can only happen if you have this particular analytics in front of you. As a matter of sense, you can actually look into some Sharpe ratio, which shows you what is the risk adjusted return of that particular portfolio, or a sort which shows you the downside risk, which actually see the risk adjusted downside risk return. And then we have historical value at risk. So now let's take a look into value at risk altogether. So whenever we talk about value at risk, we talk about what is my most highest possibility of getting that particular risk. So as an example, if you see this 95, it is a confidence interval. So you can just see that 100 minus 95 gets you 5% probability, and this particular portfolio has a risk of negative drawdown of, can have a drawdown of negative 19.58%. Accordingly, you can change the confidence interval and keep it 99. Now here you can see the confidence interval has changed, which is a 1% probability that this particular portfolio can have a drawdown of negative 32.85. Now the exact logic of this is that if you're considering some top securities in your system, right? So let's consider top 5 which we have right now in our particular portfolio. We can click on them and pop try to onload all those securities and check their value at risk one by one, right? Now why am I doing this exercise? To see that individually what are the risks, and in a portfolio level am I minimizing those risks, right? And this is so important because when you see a 99 a 99 confidence interval, you see a risk factor of negative 32.85. So this historical is based on the historical return of the annual historical return of the entire portfolio, which is annualized, and this is what you can incur as a portfolio. Let's go ahead with Nippon India or DSP. So I'm just loading these funds up. So let's go ahead with Tata Digital India. So for Tata Digital India, if I keep it as 99, I hope this is visible to everyone, right? So here you can see that individually this fund is actually quite riskier, right? And essentially, if you load in some other funds such as HDFC or Aditya Birla, right, you will see the individual risk for that as well. Accordingly, you can take a call. If I choose in a particular start date or an end date, you can take a call that what particular type of risk I'm undertaking for that individual securities. So our essential idea here is that if we take Aditya Birla SL mid cap, right? Now here, if I keep it as 99% confidence interval, my VAR is negative 44.96. Now you as a as a advisor or as a distributor has decided that I will keep a portfolio VAR lesser than 25 to make it lesser riskier. And this is very very useful if you want to have a better portfolio based on the lesser risk parameter, right? So we are just looking into the downside risk and not the upside. So if you're looking for the entire risk, you can see that that is annual volatility, which is 12.27. But here it makes pretty much sense if you look for other parameters as well. Let's say you go for Nippon India Pharma. So this is another fund which is preferred in pharmaceutical sector. As you can see, the 99% confidence interval gives you a huge drawdown of negative 53.32. This you can actually check out for every single funds or the securities added into the system. Once you have done that, you would be able to understand that due to the construction of the portfolio you have made for your client, that's how the VAR is giving you a lesser drawdown altogether. And that's the essential take of creating a portfolio, is to manage the entire risk and to optimize the return set altogether. So that's how you can look for a risk parameter accordingly. And you can also go for an implied value at risk. The differences between historical and implied is as such that historical is calculated based on the historical returns and implied is calculated based on the historical volatility. So if you keep it as a 99% confidence interval, you will get some set of drawdown based on the historical annual VAR. It is also called as modeled VAR. But as a matter of sense, if you really want to use a VAR, you can use this historical VAR, pretty easily. Now let's go ahead with some relative thing and some, monthly and yearly chart. Yes, we look for performances and we would like to know that what are our performances on monthly level. Now here, to just read this chart all together, I can just say that, the number of up months I had, positive months was 100, and, negative months was 52. So my possibility of, having a positive month is actually, in the distribution sense, is 65.79%. And that's how you can actually take a look into, and that's my average up months and that's my average down months. And that is as least, as low as I have gone, as worst returns I've gotten as a portfolio altogether, right? So this you can view accordingly in the monthly chart as well. And here we have yearly chart. In the yearly chart, it's the same logic altogether for monthly chart as well. You can actually look into those up months and down months and then compare it all together with average volatility and best what you have incurred in a particular year, and the worst as well. So you can see this is the best performance in 2014 for this particular portfolio altogether. And That's how the performances, you can look into. We are not talking about too much of a relative performance here, but one thing you would definitely want to look for is the capture ratios, because if the capture ratio is lesser than 100, it means that our return set against a benchmark is not actually pretty, well against the benchmark. We have not performed that well, but whatever, annual return over benchmark we have is due to the down capture. So we have, gotten lesser losses than a benchmark. As you can see, our negative returns were, lesser than a benchmark, which is negative 34.30. And you can also see the monthly breakdown of the same, right? So this, capture ratios are also pretty much important if you're, looking towards a relative set of performances. And you can choose a benchmark here altogether. We have given a change benchmark option here so that you can easily choose the benchmark. Now here, once you have looked into the performances, we can also look into some rolling analysis. Now, why rolling analysis? Because we would like to know what is the expectancy accordingly for a, let's say we are investing for a 3-year period in this portfolio. So what should I expect from this portfolio? Should it be, like 50%, 80%? What should that be the case? If we are expecting, like, let's say 70%, right? So it's not that much, because you can see 70% is the highest, this portfolio has actually, back tested for a 3-year period, right? So this, this is actually a, less likelihood to, get it again. So my initial likelihood to have a proper, set of return from this portfolio in an absolute format is actually 35.84% for a 3-year period. And so 260 is considered as 1 year. 520, 2 years multiplied by 2 and multiplied by 3 gives you 780. And you can also go for 5 years, let's say 1300, and you run the portfolio. So as you can see, this is how the 5-year rolling returns looks like for the, from this particular start date. And here you can see that I should expect as an average in an absolute format, and I can annualize this as well. So if I analyze this, I can say pretty much that for my on the analyzed basis, I should expect 12.42 altogether for the period of 5 years. So that's how this works out. And you can also, look for the lows, because the lows makes a lot of sense. If the lows are decreasing, you can say that, if I invest for a 5-year period, my lows will be lesser. I will be more towards positively, my entire portfolio can go towards positive, in a positive distribution altogether. And then we have rolling volatility. Now rolling volatility is where, it starts about all, how the volatility has been from the start of, 2019 2010, because this is our start date altogether. And you can see how the volatility has been for a period of 1 year. So in this period, there are several times the volatility has shot up. And even in this time of, COVID, as you can see, it has shot up pretty highly, like pretty, exponentially, it has just shot up. So this, you can actually look into that at what periods of time this particular portfolio gets too much volatile. And why this is the case? Because we do have such funds inside our portfolio which are very risky. We have, you can see this as Nippon India and, Tata Digital India. These are risky funds, based on the value at risk. So that you can actually look into and, actually see what allocation should be given to a portfolio accordingly, when you're looking for towards a risk. So this, days considers, as I've told you before, as 1 year, 2 year and 3-year period. This is 5-year period essentially. So you can change it from here. And you can also look into the volatility of a volatility. So it just basically means that how volatile is this particular graph, and how has it been behaving for a period of 1 year, 2 year and 5 year. So this you can actually view, pretty, easily here. And you can say that it has become pretty much volatile in a 2nd-year period, where you can see this is the, volatility altogether. And then you can also look towards drawdowns. Now drawdowns, so drawdowns are is one of the, most important place where you can look into that what are where the losses in the previous losses in the portfolio and how many days it took to recover. So as a, in this sense, you can see the highest drawdown we had as a portfolio is negative 28.57. And let's consider other funds. We are just checking out a portfolio. Let's consider Nippon India Pharma and compare it, right? You can also compare it directly with, within portfolios to portfolio, but as we are comparing the, funds, you can see that drawdowns are pretty high for this particular fund, right? So essentially, when we made a portfolio altogether, we have actually reduced a lot of risk. So this is, this is the way to validate that, what portfolio we have made is actually lesser riskier. And here you can essentially see those, days to recover here. So our, one of the biggest loss is just having a recovery days of 96 days. And you can also see one of them is actually started recovering. So we have given, in days to recover, if it is recovering like 50%, 80%. So we actually show this up in the drawdown section. And you can also, check it out, all these gray areas. So these gray areas can be confusing for you, but these gray areas just shows you the drawdowns. So as a matter of fact, if I just zoom it in, just like this, you can see this gray area. So these were the drawdowns altogether. This is the one of the big drawdown we had. So it started in 2018 and it ended here in 2020 in March, 19th March or 20, close to that particular day, 23rd March. So it took a lot of time for just, having a loss. And then the recovery period was pretty much, very high. And that's what it shows you here. The recovery date was August 2020. So that's how this works out for any such drawdown you look into any portfolios. This you can review for your own, prospective clients as well. And you can also review for your, in existing client from the client section. So all you have to do here is, you have to just click on one of your client and run analytics. So once you run analytics, you can view that drawdowns analysis altogether in this particular tab. So that's our second last tab we have given you in the drawdowns. And this is how you can see this is one of my existing client. And the, biggest loss actually I had for my client was negative 35.79. And that is what my days to recovers are. Now it's still ongoing, 0% recover. Might be that this portfolio can fall furthermore. And that's how you can, look into when you are reviewing a portfolio based on the risk parameter. Now here, let's check some, holistic view. So what do I mean by holistic view? Let's see how our portfolio stands against certain benchmark based on risk and return. That is an essential, topic altogether to show you. So, what you can do here is you can make your portfolio as a customized securities. So how to make a custom security? We have given one tab here, which is download price series in CSV. You just have to click on it and your price series is downloaded. So I'm just opening this up. So once that opens up, all you have to do is you just have to come into my securities here and save it as a custom securities. So I'm just going to show you a demonstration here to save it as a custom security. So this is a price series of a portfolio we had. We don't need return here. We just need the date and the price. So all I have to do is just copy this entire thing and then paste it in my custom securities section. So once I paste this here, you can see this is where the entire, price series is, onboarded. All I have to write is a name, any name, let's say prospective client. Once I've written that, I just check it as, any asset class, as this is a portfolio, and, validate it. So once I validated, this is the price series of my portfolio altogether. I save this. Once I've saved it, it will be saved into my system. Now I can actually compare this with certain, multiple indices altogether into the compare tab. So now our compare tab is more updated and more robust. You can actually compare a lot of things, even stocks, mutual funds, and customized securities. So, non-standard asset classes here. So in the compare tab, all I have to do is add in my custom securities here. So, you can see my custom security is this prospective client, and this is added into the system. Now here, if I want to actually compare it to some index, so we have given add other items, which is select index. So I just have to select some couple of index. I'm just adding in some, standard indices here, Nifty 500, and let's add in some index like Sensex, and let's add furthermore to, go some thematic ones as well. Maybe let's go for pharma because we had a huge pharma exposure in our portfolio. Now let's compare our own, portfolios with all the indices in risk versus return tab. So all I have to do is I just have to click on risk versus return, and that's how you can see that most of the, indices are highly risky, and you can see their returns that are not that much, based on the annualized return. As you can see, this is annualized return in the left side, and this in the, horizontal way is annualized risk, which is standard deviation. Now you can actually see that prospective client or our client is actually having a low risk high return, right? So accordingly, the review you can take, that, based on these indices, this portfolio is actually making a lot of sense. And maybe this can be your own model portfolio. I can add my own model portfolio all together and compare it all together to show the client, to convince my client that what I've made for you is actually making a lot of sense. And you can change this date. So any date accordingly, you can change this point to point date and to check if the portfolio is still in this, particular quadrant. And might be a possibility that sometimes BSE has given a lot of returns, but subsequently it is also having some underlying risk, right? But against Nifty 50 we are actually having a similar set of returns, but we are taking considerably lesser risk against Nifty 50. So that's how you can look into. And furthermore, let's do one more thing, is let's remove this all, let's remove this all indices, and let's compare our prospective client, or let's say a client or maybe a model portfolio, with our constituents of the portfolio we had before. So all I have to do is just have to see where my initial portfolio, where it was onboarded, and then I can actually compare it with the constituents of the portfolio. So just give me a moment, I'm just checking those constituents all together. So yeah, this is the one. Now these are the constituents of the portfolio I've added, right? And I'll just add my own custom security, which was my prospective client. So just give me a moment. So yeah, now these, except from the categories, I'm just gonna sort it with the category. This is the custom security, and these are all my constituents. So inside them, these were the funds which this particular portfolio was holding. Now let's compare it in risk versus return and show the client that where our portfolio is actually standing, right? Now here, most of the funds you can see are quite risky. As I've actually stated, Tata Digital India is one of the riskiest fund. And due to what? Due to the some parameters such as VAR, you can check VAR and actually find that some of the highly risky funds in the portfolio. And you can see this is where we are standing as a portfolio, and this is what our constituents are. So as you can see, this is very, very interesting to see that couple of securities. So this portfolio is actually having one of the lesser risky security, and others are in a similar range, and there are some others which are highly risky. That's what my constituents of the portfolios are, and this is what my portfolio is. So this is actually, you can take a call based on that. And one thing for sure here is that you have to take into consideration the minimum common period. So a minimum common period, as you can see, let's say this HDFC Banking and Financial Services, due to this one fund, our minimum common period is just from July 2021. To change that, all I have to do is I have to just remove this. Right now, I can just run it back more than 6 years or 5 years accordingly with a minimum common period, and I can check my risk and return for that particular period. And that's where I'm standing as a portfolio, and still Tata Digital India is in a highly risky domain. So this is where you can recognize that if a client, if there is a prospective client you have approached, or a client has approached you, all you can do is you can just onboard the portfolio from here, right? Once you have onboarded, all you have to do is just click on this compare button. Once you have onboarded, You click on this compare button and all the securities will get, onboarded here in this system, and you can look into the risk versus return, and you can check that, okay, so this is the entire portfolio's concentration, and accordingly you can take a call. So one of them is Sun Pharmaceuticals, highly risky, accordingly, and then you can take a call based on this risk or return parameters. And one thing for sure here is you can also look for rolling analysis. Now, why am I talking about rolling analysis? Because rolling analysis gives you particular sets of analysis. So here we have actually have a new update. Here we do not consider minimum common period anymore. You can actually go and backtest it as 2015, and only those funds or securities will run which are having that particular data set. So if I keep it as absolute and simple returns, so it will start from 1st July 2015 till 2022, and you can see what is the average. So you can say that these are the two young funds, but other funds did had some other funds, and stock, one of the stock did had some data set altogether. You can definitely say that one of the highest volatile security is Sun Pharmaceuticals Limited as a stock. If I remove that, right, if I remove that, I might lose on some returns altogether, and it will be a considerably a pure mutual fund portfolio altogether. But I would definitely see what is my actual wall and average altogether. So let's start it again with this and run it, and I can actually recognize the highly risky securities here. So this is how this works out. If there is a Tata Digital India with the data set, if I choose in some data set, maybe 2019 2020, I would definitely see the data set of those particular securities. So this is how this works out, and you can see one of the highly risky is Tata Digital India as of now, on the basis of rolling analysis. And you have to take into look that what window you have chosen should not be higher than the start date and the end date. So otherwise the analysis will not run, because there will be no set data point available to actually compile the absolute and simple returns range. So this is how this works out in rolling analysis as well. We can do another exercise here. If we remove this all and we add in those indices again, right, only 2 to 3, let me add in 2 to 3 here, and let's see the consistency altogether against the portfolio which we had onboarded in the last couple of minutes before, and see the rolling analysis of that as well. So now from November 2009, I can say that the most positively tilted, or most positive percentage which has rolling periods in the positive region is actually Nifty 50, right? And that's how you can actually take a call for a 260 period in an absolute or a simple returns format. You can definitely, our volatility is higher, but we do have a good average altogether. And that's makes a lot of sense, because you can see that is how if we invest for a 1 year period in this particular portfolio, that is how what our entire graphs looks like. So we might have some low highest drawdowns altogether, and some lesser returns sometimes, but we are still having a better average. And this works out pretty well for any security. So if I add in some couple of mutual funds here, any mutual funds, any category altogether, I can actually recognize some of the funds which are least consistent. With a matter of fact, to just recognize least consistent security in a portfolio is just to look at rolling analysis, and to just look at positive percentage. So if I remove, if I keep it as a minimum common period of 8 years, you can actually review those securities and see what what is the least positive percent. So Aditya Birla SL mid cap, PGIM India, as you all know, PGIM started performing after 2020. uh, After 2020, before 2020, you can look into the performance chart and actually figure it out yourself, that before 2020 PGIM India was nowhere to be seen. So in rolling analysis, that's how rolling analysis depict that even if you have a higher average, you're still having a very low positive percentage. And this makes pretty much sense that if I'm going for such a fund, I'm gonna take a lot of risk. And if my client is conservative, I would rather have my client to invest in some volatile rolling wall fund with a good average, maybe DSP or maybe Investco or maybe Access Mid Cap. Depends on the risk taking ability of a client, or or a client or a portfolio of the client. So that's how this works out. Let's talk about our second topic, which is the customized report, PPT reports. Customized reports is all about, you can talk about, you can just click on this PowerPoint and you can add in a capital. So let's say we have a model portfolio, right? So let's say I, as an advisor, have a model portfolio of high risk. Now I want to suggest this to my client. Okay, let me just use another one, this one, right? Now if I want to suggest this portfolio for my client, uh, I can just click on this PPT report, and I know my client is holding, like, let's say 50 lakh of the of the capital, and I want to suggest this entire portfolio. I can create this PPT, and the PPT will be generated within a matter of seconds. So once that is generated, you can review the portfolio. Once you have reviewed that, you can also review it in the base of capital. So what allocations of the money which is going which particular securities, and in which particular sectors, that you can view entirely into the PowerPoint. So you can actually look into, you can, as you can see, this is the 50 lakh as a capital. You can see this, you can change this up. I have actually taken a lot of time to sometimes I can definitely change some designs here. I can make a customizable report, write some of my suggestions here directly here. So this makes pretty much sense to show that his 7 lakhs of his entire portfolio is in banking, followed by IT software, then finance and pharmaceuticals. And you can also talk about the performances and the rolling stats, and then there is a drawdown. So why this is very useful. So let's say there is a possibility of your client not even taking a call on rolling wall. Now this is one very subjective question that not everyone will understand what we are talking about. So you can just remove this altogether and just keep rolling return, right? And this is pretty much useful, because if you want to filter this out, you can just keep it as, let's say, if the client is investing for like 780 days, just keep it for 780 days, and only those particular data points will be shown all together for 780 days. So that's how this works out. And you can also look for rolling returns. So these are all PPT functions. It's very customizable. You can change it up altogether, revamp the thing, and make it your own own research report altogether. And definitely you also have your own customized company logo here. So this helps you in because the PPT cannot be made within a matter of seconds or minutes. We require hours to compile such a PPT. This is very useful to actually impress some HNIs or ultra HNIs altogether, as this is being used by many institutional clients as well. So that's how this works out. And apart from this, we can talk about Excel a lot. Excel, we have given a lot of lot of functions here where you can download those Excels. So let's say top AMC exposure, you can download those, all those AMC exposure. I can just copy this up, paste it up, and paste it in my PPT. So as I have the PPT, I can do n number of things from the platform, because you have all the accessibility of the data. So let's say I just want to put in all those debt securities in the place, right? So here you can just open this up, copy those all debt securities, or maybe top 10 debt securities here, right? And paste it into the PPT report. Yeah, let's say you top 15 debt securities, and you can directly paste it into the PPT. So PPT, if I may show you here, is that you can use it accordingly, accordingly as per the customization. And apart from that, it's very useful if you want to share it in a very professional way. So this makes a life pretty much easier. uh, Next is the client link I'm going to talk about, is that it's very useful because it takes time for you to share it, download the PPTs, and download the PDFs from the system. You can create a generate a random pin. You can keep a benchmark altogether, let's say Nifty 50, and you can preview it all together. Keep a capital of 50 lakhs. So let's say my client is having a capital of 50 lakhs, right? And then you can send it to the client. So let's say I'm just typing in a random number and I create the link, and that is done. Once this is done, a message like this will be sent to the client. So I will show you the message. This will be the message. So this will be your name, not NGEN Research, your name as per the login, and this will be the pin, and this will be sent directly into the client's number. So any number altogether can be sent. So this is a very good way to actually review the portfolio. And you can also change the benchmarks from here, may deactivate some of the client links altogether, to so that it may not be misused by some of the clients. So let's say if you deactivate this, you can just see this is how it will occur. So that is what about client links is all about. So we have actually completed the session. We can start with the Q&A. We have Arunab sir on board as well. So please shoot your questions via chat or or verbally.
Yeah, hi,
Yeah.
this is Abhay Sinha from Hyderabad. I have few queries. May I ask right now?
Yes, sir. You can ask.
Hello.
Yes, sir. You can ask.
If you can just go to the home page, where we are. Yeah. I'm just asking that question. If you can just go to the home page, please.
Okay.
The first page, what we get. Yeah.
Yeah. So is it visible to you?
So yeah, it's pretty much visible to me. And I just wanted to understand, not this one, the one which captured the portfolio details with analytics.
Okay, got it. This one.
You can run a portfolio.
Okay, let me run some portfolio.
Yeah, this page. So I just wanted to understand.
Yes, sir, your voice is inaudible.
Performance, please go to performance once.
Okay.
Yeah. So just wanted to understand, when you talk about CAGR return here 12.33 and annual return 12.37. So this annual return is the cumulative return divided by the number of years?
Yeah, hi, this is Arunab. So the annual return is actually the simple annual return, which means it takes the average daily return and multiplies it by 260 for the number of working days in a year. So this is a simple annual return, and CAGR is your standard CAGR formula with the end point and the start point.
Okay, fair enough. Second question is coming to volatility. When I look at annual volatility and I try to understand what kind of range I am going to get out of this annual volatility, can you throw some light on this?
Yeah, so that's something we have a nice view of. Let's go to rolling analysis, and if you scroll down all the way, you'll actually see rolling analysis of standard deviation. So, for example, what you're looking at here is volatility or standard deviation calculated for every single 260-day period in history, one by one. So every single point on this chart is a separate volatility calculation for the previous 260 days.
So can you just hold it on one point? If it is, let's assume, 21st March 2016.
Yes.
So this is last 260 days volatility.
Correct. So this is the standard deviation of the last approximately last 1 year, annualized.
Which is 260 days considered in this stats.
That's it.
Okay. On the right side, you have something called as rolling volatility statistics.
Yes.
How do you get this high and low? Because normally, is it high volatility or it's
No, so
What is
you're right. It's high volatility. So this is the highest point on that chart, right? So basically, the high and low is showing you that using 260 days as the window, the highest vol 1 year period is 22.01%. And the lowest volatility 1 year period is 7.49.
okay?
So there was a 1 year period at some point where the vol was so high.
No, but this is 260 days, right?
Yeah. So there was I'm using 260 day and 1 year interchangeably. So
any given day, it was 7.49%, which was on the lower side, and 22.01% on the higher side.
For the previous 1 year, yeah. For the previous
260 days, right?
Yes.
And this 22.01% would be an add-on number to 3.21, or it will be a percentage?
No. So this is the actual volatility. So this basically means, Umair, let's try and focus on the high point on the chart. I mean, we can approximately get the date, whatever you can get near it. Yeah. So let's assume this is the one. Just stop on one point. So 29 Jan 2021, the previous 12 months. The previous 260 days. If you calculate the standard deviation of the previous 260 days from this day backwards, you would get 21.89% annual volatility.
Okay, cool. Just wanted to check on that. There are some other queries as well on the first page, if you can go.
Sure. Yeah.
I visited some of the performances for individual mutual funds and trying to understand Sharpe ratio for them.
Yeah.
What's the risk-free rate considered? Is it common for all the funds? What we have?
Yeah, it's the 10-year bond rate.
And what would be that?
So you can check it on the market screen. It's updated reasonably regularly, 7.58.
So this is what we are considering here.
Yeah.
Okay. Also on this macroeconomic data, I was looking at some of them. When I click on the tab, it shows me data for say unemployment data, or say inflation data for different country.
Yeah.
But it doesn't give me the source. So if at all I have to put this on my PPT for representation, how do I go about it?
I see. You mean you want to quote a particular source that this data is coming from?
Yes. Otherwise, this can be compiled by anybody, right?
Yeah, that's true. I mean, see, we have a variety of different data providers. So
it's okay. Even if it is shown as from NGEN Research, it's fine.
Yeah.
Some reference point has to be there.
Oh, you mean so when you take a screenshot or something?
Yes.
Okay,
Let's assume I want to quote this on my PPT.
Right.
Basically, this data point doesn't make any sense to my client on PPT because it's simply a data point without any reference.
Got it. So yeah, what we can do is, we can actually, it's fine. We'll write this down. So we can, in this screenshot, we'll put a little small source thing here. So when you take a screenshot, it is clear. Okay, no problem. We'll do that.
One more feeder here. See, I wanted to understand, my GDP annual growth rate. If you can just click on that.
Yeah.
Just click on that. Yeah. Now it gives me growth rate for different country. Is it possible for me to look at the trend growth rate for India only for the last 1 year or last 10 years?
Yeah, this is something that people have asked for. We have finally been able to get access to this data. So unfortunately, I'm unable to give you any timelines on this yet. But this is we are definitely going to get this done. So next to the compare icon, you will also get a history icon. So instead of comparing, you'll be able to see one data point, but the history of that data point. So it's just a matter of us getting the data now. So that should be coming soon.
Okay, thanks a lot for that. There are two more queries.
Sure.
One, I went through your normal distribution, histogram graph. It is just showing me the distribution of the return for the last perhaps 100 days, if I'm not wrong.
No, so the period in consideration depends on what start date you've chosen, where Umair is showing it with his mouse. Now that's the start date. The end date is always today, the latest one. And especially in portfolios, you can be sure, just to be sure, you can just scroll up and check, it actually gives you the exact dates right at the top right. It says data 2nd November 2009 to 15. So that's the time period, right?
Okay. So in your data point, it is from 2nd November 2009. Can you just drop down on return period?
Yes. Yeah. So let's go to the drop down for the distribution drop down return period. So this return period is basically, this is saying what kind of returns am I considering? Daily, weekly, or monthly? Right?
Okay. So if I look at monthly, it will be from 2009 monthly distribution.
Yes. So it will be looking at monthly returns from 2009 to now.
Oh, okay.
And dividing the entire range of monthly returns, meaning the worst month to the best month, into 10 different buckets, as you can see below in the bar.
I can see
and
that.
Then showing you the frequency of monthly returns within each bucket.
Okay. Is there a possibility of adding bar in this graph? I mean, do I have that option?
So what do you mean by adding bars?
So you have 5 tabs on the left, quoting mean, median, mode, and skewness. There are 3 methods of representing the returns here: mean, median, and mode. And one method of perhaps highlighting historically skewness, which is what the tail risk is. So is it possible to look at how fat my tail is, or how deep my VAR is at 95% confidence level, at 99% confidence?
Understand. Okay, so you mean to say you want to
use graphically, not number-wise,
represent VAR as well. Yeah, that's interesting. We can try looking at that. Yeah, fine. I understand. Yeah.
Okay. Can we just move on to the next tab, please? Scenarios.
Yeah.
Is it customizable? I have seen some of them, and it says that add custom scenario.
Yeah.
Is it operative? Because I tried to add, rising interest rate scenario for next 1 year.
Okay. So no. So that this is not what that does. I believe what you're trying to do is trying to stress the portfolio by changing interest rates.
Correct.
Okay,
I'm trying to understand the factor impact on the portfolio.
Yeah. So no, this is not. This is definitely not doing that. This is a simple case of picking a particular time period and focusing on it, right? So in our case, what we mean by scenarios, this is a very simple. Yeah, this is just a past scenario. This is not the scenario analysis that you're talking about, where we actually stress interest rates and then apply the effect of that to the portfolio. That's not what this is doing.
Okay, great. One more question on risk and return distribution for various schemes. If you can just go there.
Yeah. Let's go to compare and this return.
Yeah.
So here, right? Compared to portfolios?
No. The compare section and risk versus return. Yeah.
Now, see, I have understood the utility of this graph. My point is, let's assume I'm looking at Motilal Oswal Midcap 30 fund.
Sure.
Right. This graph can be misunderstood easily because we all know that funds move in cycles. Every fund has got relative cycles to perform.
Yes.
So if thematic fund is moved in at a high risk, high reward situation, we all knew that IT segment did well last 2 years. So it's quite skewed.
Yeah.
The point is, if I look at standard deviation as a factor and punch in a standard deviation, will it throw me some return oriented portfolio or mutual fund scheme? So let's assume on Motilal Oswal Midcap 30, I have a standard deviation of around 18.5.
Yeah.
If I look at returns vis-a-vis 18.5% of standard deviation, do I get such options to filter MF schemes with high standard deviation?
I see. So
because this is what you are representing here is not the true picture, because what has happened is only graphically shown.
Sure.
And we all know that we all move in cycle. They may not be the same repeat, and that's why you have the movement of fund across quartile 1, 2, 3, 4, right? Depending on the allocations what they have.
Yeah.
So it doesn't make any sense to me how to utilize it. It's only pictorially we can show it to client that okay, this is what it is.
So here, well, the thing is, right now, what you're looking at is basically analyzing a particular time period to see what happened during that time period. In this case, we're looking at about a 1 year period, right? So this shows you that in this 1 year period, Motilal Oswal ended up over there. Now, if you want to look at, and again, the reason this might be useful is because these lists of funds are pre-selected for you, probably because one of your client portfolios has it, or maybe because you've created a portfolio with these particular schemes, and then you want to analyze further. So this is not a discovery tool as much as it's an analysis tool for an existing portfolio. So
okay, I think in a statement you have made the answer.
yeah.
All right.
Yeah.
There is one more because you have.
And sorry, if I can complete one more thing is,
Yes,
Umer, just go to funds, and for discovery, I would point you to this section, screener. Go to screen.
I was asking you to go there only.
Yeah. Okay. Perfect.
Okay.
So you have to kind of, in this particular case, you do have to kind of narrow down to some categories, as Umer is doing now. So just select a few. They say, okay, large cap is fine. And then so you have to start with it's best to start with a couple of categories. Obviously, you can also kind of select your columns according to what you have there. You can filter the AUM, and this is where you can quite quickly get some very easy answers that in the categories I've selected. Let's say sort by standard deviation. So I'm looking at vol. You were talking about high vol funds. Very quickly, I can get some answers here, right? What are the really high vol funds in the categories I've selected, or the other way around, very low vol funds, etc. So it gives you some answers, but then to get further drill down, it ideally you should from here move on to the compare section, where you can do more focused analysis on a smaller list. This particular screener is much more useful for navigating the entire universe. So if you're trying to find a bunch of nice large cap funds, then you should start here. And, as Umer is doing, add to your shopping list and just add more, even if it's, half good. And then you can always kick it out in the comparison stage. So over here, he's got a bunch of funds here. He can do some rolling analysis. We found actually that this column, the positive percentage column is quite insightful. We've used a 260-day period here, but you can increase it or decrease it according to your requirements. But again, at this point, I might decide, for example, that below a certain number, I'm not happy to have funds in my portfolio or in my shortlist, which are not at least 80% of their 1 year periods are above zero. And below that, I don't want it. So I can just start kicking them out, basically. So for discovery, I would suggest start from the screener and then move to the compare section from there.
Okay. There was one segment where we can improve the portfolio, on the basis of volatility and return, right? Return ranking. I tried to use this.
Sure.
Just wanted to have a little bit of an understanding around it. This was discussed last time.
Correct. Yeah. So we can go through it now. Let's run it.
Just a second. Just give me a moment. I'm just. Yeah.
Yeah, there we go. Would you like an overview, or do you have any specific questions?
If you can just explain this slide once,
Yeah. So basically, we take the list of funds you have. So in this case, we have 5 funds, right? And you have some particular allocations to it, which is in the original column. So if you look at the columns as separate ideas, the original column is what you have put in. And we've just given you a simple analysis of that. This is the annual return, this is the annual vol, and therefore the Sharpe ratio on the top, 1041, 1050, and 0.27. Then after that, we give you 7 different portfolios with the same funds, but different portfolio weights. One of them, which is on the far right, the equal weights one, that's basically just simple. I mean, we just put the equal amount of money in each of them, just to give you a comparison that without just blindly allocating equal amounts to every fund in your list, what do you get? So you can see the return, vol, and Sharpe ratio for that. And then in the middle, you have 6 different suggestions of how to weight these funds within your portfolio. And these 6, 3 of them are from a ranking model and 3 of them are from a value model. And within each model, we focus on the same 3 parameters: return, vol, and Sharpe. So in the ranking model, you get a suggestion from focusing on returns, and that's the portfolio that you see. You can see the Sharpe ratio has increased, the return has increased, and even though the vol has increased, the return has increased enough to get the Sharpe ratio a kick higher. And you can see the portfolio weight below that. Again, same thing, ranking vol model applied to vol, obviously low vol being good, bad, high vol being bad, and then ranking model applied to Sharpe ratio. And then the same thing with value models as well.
Okay.
Okay, hi. Yeah, this is Sandeep here.
Hi.
So we had a few questions. So is it
Sure.
possible to get Jensen's alpha and Traynor ratio? And also, is it possible to get the rolling information ratio and Sortino ratio?
Sure. For the rolling information ratio, I think that's a great suggestion. That's something we can look at adding as an option in the rolling analysis section and the compare section. Yeah, we can write that down for sure. I think you can expect that to be done at some point. And the other one, in terms of the Jensen ratio, we haven't put that in so far, but I don't see why we can't. I mean, obviously, you know, it's a relative statistic of the fund and the benchmark, or a portfolio and a benchmark. So it would, you know, not show up when you're looking at individual ratios like Sharpe ratios. It will typically show up in the relative, yeah, right there, where we have information ratio, etc. Yeah, we can have a look at putting that in.
Yeah, and also Jensen's alpha and
Jensen's
Traynor.
alpha, right? Yeah.
Yeah, yeah, and Traynor ratio.
And trainer, yeah.
Yeah.
Jensen's alpha, okay, and trainer ratio. So again, both of them will be relative. So they will only show up when there is something to, you know, compare with.
Okay, right. Thanks.
One more question here, Abhay from Hyderabad. See, I was looking into some of the stocks, you know, financials, both on P&L and balance sheet side, if you can pick it up. Most of the places, I see a lot of data points coming in, but there are certain stocks where we don't see OCF or cash flows data point throw in. These stocks are still big enough, you know, to showcase the data points. I mean, any reservations?
Yeah, so our data provider in this case is Reuters. Now, and these stocks are in this particular section, these stocks are NSE stocks. Everywhere else, the source is BSE, at least for prices. So here, may I just click on any stock? Let's just see. So yeah, so these are the fields we get. I mean, this is basically, you know, we haven't, as you can see, in terms of fundamental analysis, we haven't done any analysis. We're basically just, you know, simply showing you the data in terms of what's available.
So for example, you know, cash flow is totally missing in this.
Right. Yeah. Operating cash flow, free cash flow.
Yeah, that is something, you know, which is quite technical. If somebody has to calculate, you know, you need to get into a lot of data points, both from balance sheet and P&L.
Right.
I mean, since this is a software which is showing so many things,
yeah,
if it is added, it will be very helpful.
Understand. So we will look at it again. You know, generally speaking, what you see here is what's available. We can have a check again, but my initial guess is if it's not showing up here, that means it's not there. And we can obviously get in touch with them to see why not. I mean, obviously this. You're talking about a very big stock here, and ideally it should, you know, it should be there. So we will check it out. We will check it out.
Okay, thank you.
Thank you.
So there was another, suggestion by Shaket Kapoor that can you please add more tools like SWP, STP calculations of fund?
Yeah, sure. The next one on our list was SWP. It had got slightly delayed due to the other features we were releasing, like client links, etc. Another release just went through this week. So we definitely get to it. We apologize for the delay here, but SWP will be coming sooner, and STP after that. But SWP, hopefully, we will be able to get down in the next 30 days or so. And there's another question about recording. So Umair, can you just please show everyone the YouTube channel, and all of this is available. So Umair will just show you.
So these are the recordings which are available. You just have to, click on your system, demos and training, and a YouTube channel will open up named NGEN Markets, and you can view all those recordings. We are regularly adding those recordings in YouTube. So you will be updated based on all the, updates we have as well.
We also keep updating on functionality and other overview videos on a reasonably regular basis. So ideally, if you subscribe to it, you'll get an email or a notification, as and when these videos are uploaded.
Are there any other questions?
Okay, doesn't look like it. So maybe we can close up for today.
Sure. So thank you so much, everyone. To coming to our sessions, we will be, furthermore improvising ourselves in, giving you all the trainings and support. There's another question we had from Shruti Kansure that where can we get this recording of this session? Yes, ma'am, you can get the recordings from demos and trainings here. I'm just repeating this again. You all have to do is search on YouTube, NGEN Markets. All the videos are available. You click on this bell button. Every single week we are adding these recordings for your own benefit. If you view all those recordings, you might not have any doubt to ask us, because you will be all together knowing the entire set of the platform. So that is all our initial purpose of the thing, is that you should know in and out of the platform and use it fairly seamlessly. And so thank you so much again. I just got a message from Pramod sir as an appreciation message for our team. So thank you, sir. And definitely we will improvise ourselves as well. And have a nice day, everyone. We will meet again in the next week, tentatively same time, on Friday, 4 o'clock. We will have another session with something different as a topic. And do visit us, and do have your queries so that we can address them. Thank you so much. Have a nice weekend to everyone.